Hi guys, a very good evening to all of y'all. Hopefully my screen is visible. Okay, so today we will be looking at a question which is known as Columbia Co, which was tested in your March-June 2021. Okay, it's the similar, exact same type of question that was tested previously, which you can see in your fifth question, right? The exact same type, the same structure. Okay, so let us go into our requirement. Right? Here examiner has given us what do you call he has given us requirements as well as sub requirements, right? You can see that he has given us requirements and sub requirements which is equivalent to 30 mark, and this is a company accounts question or a group account question, right? So give me a minute guys, give me a minute, let me erase all this. Okay, so what does he want us to do? He wants us to give an explanatory note, right? He wants us to give an explanatory note on for 8 marks, right? And for 5 marks, right? And this explanatory note is not only for your very first requirement, right? I believe that it applies for B as well, right? It applies for B as well. So what you all need to do is your very first requirement says is what you all need to do, you all need to give an explanatory note saying that is Columbia Co an acquirer of Peru or not, right? In simple terms, in simple terms, is Colombia parent or not? This is what the examiner wants from you. This is what the examiner wants from you for 8 marks. Is Colombia a parent or not? All right. So take about 1 minute. Take about 1 minute. Right. Take about 1 minute. I want you to say what are the standards that is relevant to this. What are the standards that you all feel that is relevant to this? What are the standards that you all feel that is relevant to this? Well, I would say, sorry, I have written this right. Sorry. Okay. Okay, we can bring in IFRS 3 since I wrote it down, right? That is business combination, right? You can bring in IFRS 10, right? Which is control. Why control? Why control? If you all need to be parent, right? You all need to have more than 51% of ownership, right? That is when you all have more than 51%, you all get control, right? So that is why I'm bringing that standards as well, right? And associate IAS 28, IAS 28, right? You all can bring that as well. Okay, so let us go and read. Let us go and read into our exhibits to find out whether he's a parent or not, whether Columbia is a parent or not. Okay. So now you all might be asking, they have not mentioned, which requirement or which exhibit that we are supposed to use. Well, let us go and read and see. Okay, for the people who have now practiced this, right, we are doing in a very sixth question. I don't think that you all might be struggling to find out which exhibit that you all need to read. Okay. So by looking at the background, right, Colombia has acquired a new subsidiary. Fine. The current financial group year end is 31st December 2005. Right. This is more than enough. This is more than enough for us to tackle. Right. So here it is. I have written. The question is, I need to argue whether he's a parent or not. Right. He's a parent or not. And you all very well know that if you all need to be parent, you all need to have control. Right? Control, you all need to have or more than 51%, right? Or more than 51% of ownership. All right. This is what is needed. This is what is needed. If you all need to have, if you all need to be a parent, you all need to have control. If you all need to have control, according to the rules, according to the standard, right? You all need to have more than 51% of ownership. Okay. Okay. So let us go and read and see. Let us go and read and see our very first paragraph. Okay. They have gone and acquired a company called as Peru. Okay. Brazil is a competitor of Colombia. Fine. Right. On 31st December, that means during the year end, both of them, Both Brazil and Colombia acquired 50%, right? So 50% was acquired by Brazil, and the remaining 50% of Peru was acquired by Colombia, right? Who is a competitor, right? Both of them are competitors. They have gone and bought 5 million ordinary shares, right? Both of them have gone and bought 5 million of ordinary shares. Okay, obviously, you all don't get ordinary shares for free, right? You all need to pay. How much is it paying? Each share is valued at $8, right? Each share is valued at $8. And this is from the perspective of Colombia, right? Colombia is paying cash of $8 per share of whatever he acquires, right? This is one way of him paying. This is one way of him paying, right? Another way of him he is going to pay is he is going to issue share exchange of his own company. What does it say? 1 for 20. So I believe that Colombia, what he's planning on doing is he is planning on giving 20 shares of his own company and getting 1 share of Peru, right? Getting 1 share of Peru, and the market price of Colombia share is worth $10 each, right? So this is from the perspective of Colombia. This is from the perspective of Colombia. Okay, so let us go and check in Brazil. Brazil Co also paid $8 per share for their interest, right? So what happens is, guys, what happens is both of them are buying, right? Brazil is also buying 50%, Colombia is also buying 50%, right? How Brazil is getting his 50%? He is paying through cash, right? He's paying through cash, as well as he is issuing some shares, right? He is issuing some shares. That is how Colombia is paying. In terms of when we shift into Brazil, right? Brazil is also paying the same equivalent amount of $8 per share. Can you see here? He's also paying $8 per share. This guy is also paying $8 per share, right? But did not issue any shares to the original shareholders of Peru. Can you all see here, guys? Can you all see here? When you all look at the total consideration, right? When you all look at the total consideration, you all can feel who is the person giving the highest amount, who is the highest contributor, who is the highest contributor. You all can see through, by referring to this question, right? You all can feel that Colombia can be the parent. Why? Because he is giving the highest amount. How how he is giving cash plus he is giving shares. On the other hand, Brazil is only giving cash, right? He's not giving shares. He's not giving shares. So some of y'all might directly jump into a conclusion saying, look at this, right? Just because he is giving the highest consideration, we can consider him as a parent. Done and dusted. That's not the way of how y'all could answer a question, right? Y'all need to read on why examiner has a habit, right? He likes to twist, turn the question around, right? So try to read this also and get some points. Try to read this particular para and get some point. So very first point, guys, what you all will say is that you all will look at the consideration, right? Both of them are paying equivalent amount of cash, right? This fellow is also paying $8. Meanwhile, Colombia is also paying $8, right? But in addition to the cash consideration, Colombia is also giving share exchange, which was not provided by Peru. Sorry, which was not provided by Brazil, right? So by looking at this, you always say that Colombia is the parent. Okay, Colombia is a parent. Fine. Let us go and read on further to find out whether can we 100% confirm Colombia is a parent or not. Okay. Okay. Colombia has the contractual right. Okay, contractual right to appoint 60% of the board, while while Brazil only has 40% appointment. Right. So if you all have read or if you all have gone through the lectures, right, of IFRS 3, what does it say? What does IFRS 3 says? What does IFRS 3 says? What does IFRS 3 says? What does IFRS 3 says, guys? It's quite simple. What does it say? If you need to identify who is the parent, right? You all need to take some factors into consideration. You all need to take some factors into consideration, and here it is. Here it is. Here it is. Right? I guess you all also might be having, right? You all also might be having the notes, right? Go through that, and you all will be able to identify. I have taken a screenshot. Don't worry. As soon as this session finishes off, I'll be attaching this uh, Excel sheet on your Google Classrooms, Google Drives, and your YouTube videos, right? So what does IFRS 3 says, guys? What does IFRS 3 says? If you need to identify whether he's a parent or not, look at the consideration. Who gives the highest consideration? That is point number one. Number two, point number two, who appoints the board of directors, right? Who appoints the majority of the board of directors? Can you see? Can you see? Can you see? Colombia can appoint 60%, guys. 60% of the board belongs to Colombia, right? Only 40% is appointed by Brazil. So by looking at this point also, you all could say that or come up into a conclusion, right? This is a might cause. This is a might cause. You all can say, Colombia Co might be, might be a parent, right? You all can say he might be, right? I cannot still confirm. I cannot still confirm, even though I know that Colombia has 2 points in valid in favor to him, which is he is the highest consideration payer, as well as he can appoint majority of the board, right? We still need to read on to find out whether it is Colombia who will be the parent, right? Give me a minute. Let me take off another color. Let me take off another color. Brazil Co has veto rights, right? Brazil Co has veto rights. So what does this veto rights means, guys? For the people who are into politics, right? You all should have listened to this word. Veto means simply means you all have the cancellating power. You all have the power to cancel. You all have the power to cancel, guys. That is what this veto says, right? So Brazil has the power to cancel. What powers does he have? He can cancel any amendments to the article of incorporation and also over the appointment of auditors. Okay. So by looking at this green color, right? By looking at this green color, initially we were arguing that Colombia is the parent, right? You and I, both of us told that Colombia is the parent by looking at why? Because he was able to appoint majority of the board of directors. Let me write that also. Majority, right? He was able to appoint majority. But now this twist or turn by the examiner comes in. What? Brazil has veto rights. So I guess, right, some of y'all now y'all might be twisting. Okay. Who can be the parent? Look at this. Brazil has the veto rights. He has the power to. I mean, he has the right to cancel. No. So can we say that Brazil might be the parent? Brazil might be the parent. Well, this question arises for at least 5% or 6% of the people who are planning on doing your exams, right? These people, guys, these people, that 6% people have not gone through IFRS 3, right? Why? IFRS 3 says that you all need to look into the appointment of board of directors, not anything else, right? You all need to look into the appointment or the cancellation only related to board of directors, only related to board of directors, no one else, not the auditor, not the shareholder, none of them. You have to look the appointment or the cancellation of the board of directors. Can you see Brazil? Yes, he has a veto rights. I totally accept it. But over what? Over the amendments of article of incorporation? Well, that is totally invalid. And over the appointment of auditors. Okay. Go and read again IFRS 3. Go and read again IFRS 3. And if you all can argue, you all try to bring in a point showing that whether have they mentioned auditor's appointment? Have they mentioned auditor's appointment? Well, I of course have gone through the IFRS 3 statement, and I simply guarantee y'all, right? Examiner says board of directors. Look from the perspective of board of directors. Either the appointment or it can be his removal, right? Look at the board of directors perspective. Okay, so I still stick to my point. I still stick to my point saying that Colombia is a parent, right? Even though Brazil has veto rights, I don't consider that as a point. Why? Because he only can cancel appointment of auditors, which is irrelevant, right? That is point number two. This point number two, right? Point number three. Let me choose another color, blue color. Okay. Brazil and Colombia each appointed one member, right, to Peru's senior management team. So you all know how the organization structure works, right? It's the chairman. Later comes in the CEO, right, and his management team, right? So this particular para in blue color says that both of them can equally appoint senior management, right? But here it comes the best part. It is the senior manager appointed by whom Colombia Co makes the key decisions. Can you see here? Can you see here? Key decisions. So it is the manager that has been appointed by Colombia who makes the key decisions regarding the development of new technologies, right? What's their principal stream, right? What is their market that they're going to operate? Germany, Switzerland, India, right? And how it is being financed, right? So this is point number three. This is point number three, guys. Look at this. Key management personnel of which company, right? Or simply, who makes the decisions, right? Who makes the decisions? Let me rephrase it like that so that you all would understand. Who makes the decisions, right? Who makes the decisions? You all need to ask this. And in this, by looking at this blue color, right, we are able to again reconfirm or reassure that Colombia is the parent. Why? Colombia is a parent. Look at this. The person that he appointed is only making the key decisions, right? The person that is appointed by Colombia is only making the key decisions, right? On choosing the which technology they're planning on using, which markets they're planning on entering, and how it is being financed. These are all being decided by the senior manager of Colombia, right? Of Colombia. So now also we can say that Colombia is the parent. Okay. So final one is that the senior manager appointed by Colombia also provides a supervisory role, fine, where he has the right to request, such as imposing restrictions. Look at this. This shows that you are dominant. You are dominant. This shows us you're dominant or you're a parent. How? You are able to do or you're able to impose some restrictions on Peru from undertaking activities that would be significantly increased credit risk. Can you see? He is in a dominant role where Peru needs to listen to him. If he says that don't go and do these kind of activities, Peru needs to listen. So can you see what kind of power that he holds? What kind of power that he holds? Well, to be honest, this is a very simple question, right? Examiner has not given you all any twists, any turns, right? Some of you all would have slipped for this veto rights, but apart from that, this is a baby question, peanuts. This is a peanut question, right? I would confirm that Colombia is the acquirer. Colombia is the acquirer, right? I would say that Colombia is the parent or the acquirer. Why? Well, obviously, look at this. There are three factors in favor of Colombia, right? There are three factors in favor of Colombia. And if I use this, right? If I use this, come up with a proper answer pattern, right? I guess I believe that we will be able to achieve at least minimum of 6 to 7 marks. 6 to 7 marks. Right. So always be optimistic. Right. This is a very easiest question. All of y'all could attempt it. Okay, all of y'all could attempt it. But to tackle this question, you all need to know IFRS 3 again, IFRS 10, right, and IAS 28. Okay, so IFRS 3 is business combination, IFRS 10 is control, and IAS 28 is associates, joint ventures, joint arrangements. Okay, so why am I bringing this? Look at this. For some people, you all might be arguing with me, right? You all can argue with me saying that you told me that if you need to be a parent, you need to have 51% of ownership, right? That is what the standard says. That is what the standard says, right? But there, I guess I have mentioned this in my lectures as well, in my previous lectures as well. There are some conditions, guys, right? Even though you own 50%, even though you own 50%, you can have control. Even though you own less than 51%, sometimes you can have control, right? You can have control. You can have control. Even though you own less than 51%. Right? Never go and say that just because you have 50 less than 51%, he can't have control. No, there are some companies who have less than 51%, but they are the real parents, right? They can control the organization. So if you are good structure, right, you all don't need to have the exact same answer exactly like under examiner, because why? Examiner does not write under time constraint, right? Even I'm not writing under time constraint, right? You all are the people, so write it in a way where you all could relate it to the paragraphs, relate it, right? So that you all can gain some additional marks. Don't try to give these general answers, guys, because this is not a memorizing subject, right? You all need to argue in a way such as how a lawyer argues, right? He brings in some points and he relates it. So that's what the examiner expects from you as well. You all need to bring in the points, right? You all can bring in IFRS 3, you all can bring in IFRS 10, you all can bring in IAS 28, joint ventures, joint arrangements, any of those sort you all can bring in. But as long as you all relate it to this very first paragraph, come up with proofs. Come up with proofs. Right, look at my screen here. I also have drafted some answers. Right? So your answers also does not need to be exactly similar to this. Right? You all can take in the points that you all need. The rest you all can leave. Right? So give me a minute. So first of all, the very first question that you all told me, or you all would have asked me, right? So look at this. Both of them are buying 50%. So I feel that this is a control. Sorry, this is not a control. Right? This can be a associate. This can be a joint venture. This can be a joint operation that you all would say. Well, my stand is this is a control. Right? This is a control. Why? Why? Less than 51%. Even though he's less than 51%, right? There are some situations, there are some exemptions that says even though you have less than 51%, you can be a parent. Okay. So for this, you all need to go and read IFRS 10. For this, you all need to go and read IFRS 10. You all need to go and read IFRS 10. Right. So I'm also speaking about IFRS 10 here. I'm also speaking about IFRS 10 here. Here, see, if I'm telling that he is a parent, he needs to have control. He needs to have control. Right? If I'm telling that he is a parent, he needs to have control. And these are the three factors. These are the three factors. This simply, guys, this general theory. There's nothing that I took from the paragraph or exhibits, right? This simple theory. I'm saying that he is a control. Because of his control, he is a parent. How do I justify? How do I justify? I bring in IFRS 10, right? I bring in IFRS 10. I bring in IFRS 10. For the people who still argue saying that, look at this, no, 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 he's less than 51%, so he has to be an associate. What I would say for you all is, please go and read. Please go and read IFRS 10, right? There's a small exception. There's a small exception or a special case. This is called a special case. This is called a special case. Go and read this. You will be able to see what I'm referring, right? See what I'm referring. So I can say that he is a parent. How? Why? Even though he has less than 51%, he has control. He has significant control. So I'm bringing 1 point. I'm bringing 1 point. Right. Now, obviously, we play the lawyer's role. We play the lawyer's role. Right. We need to prove. We need to prove. How are we going to prove? Well, let us read on. Okay, Casey. Initially, while referring to the given scenario, this seems to be a joint venture and associate. Obviously, right? The same thing. The same question that arose in your mind happened to me as well. Right? When I saw 50%, obviously I also went and thought he can be an associate, he can be a joint venture. Right? Why? Because since both parties have equal ownership of share, right? 50-50, right? 50-50. Right? This is 50 is to 50, right? Both of them had 50-50. So based on that, we can say that they were associates, they were joint ventures, right? But no, guys, they are not joint ventures, they are not associates, right? They are not joint ventures, they are not associates. Why? Right? Why? You see, this means that none of them will have control based on voting rights. By simply looking at voting rights, look at this, this is less than 51%. You all cannot say that he is an associate or a joint venture. You all cannot say, right? You all cannot say. If I need to validate that he is an associate, I need to show that there is significant influence. Can you all see here? Has the examiner mentioned this word called significant influence? No, no. I would I would ask from you all, can you all show me the place that it says that if you all are saying that he is an associate, try to show me a place where examiner is mentioning this is an significant influence. So associate is out, right? For the people who are arguing whether this is a joint venture, can you all show me there is joint control here? Can you all show me that there is joint control? There is what you call unanimous consent. Can you all show this word called unanimous consent? Right? So that is what I'm saying. That is what I'm saying. Initially, we would have thought this is a joint venture, but it is not. Why? There is no wording such as unanimous consent, significant influence. No. So obviously, this has to be IFRS 10. Right? This has to be IFRS 10. Still, still, for the people who are trying to argue with me, another way of identifying whether this IFRS 10 or not is simple, guys. IFRS 10, IFRS 3. Look at this. The question says for you to find whether he's an acquirer or not, whether he's a purchaser or not, whether he's a parent or not. More than this, what do you all need? More than this, what do you all need? Right? More than this, what do you all need? Obviously, if they ask, remember this, if they ask any questions, sorry, if they ask any questions to find out whether he is a parent, he is an acquirer, whether he is a uh, purchaser, right? Any of these words, simply close your eyes and try to bring in IFRS 3, IFRS 10, right? That is it. That is it. Okay. So in this, is this a joint venture? No, he is not a joint venture. He is not a joint venture, right? You see, as for IFRS 11, joint venture, right? But requires unanimous consent. Here it is. So first I argued saying that this is not an associate, is not an associate. Why? Examiner did not mention significant influence, right? After that, for the people who will argue with me, saying that, sir, why can't this be a joint venture? Here it is. They have not given us any wording saying that there is unanimous consent, right? Right. So there's no word saying that this is a unanimous consent. They have unanimous consent, or there is no wording saying that there is what you call there is significant influence. So based on that, I am 100% confirming that this is related to control, IFRS 10. Okay. You see, majority key decisions are not taken with unanimous consent. Go and read IFRS 11 also, guys. Go and read on IFRS 11, right? You all will be able to see. Go and read in IFRS 3. You all will be able to see. Go and read in IFRS 10. You all will be able to see. Go and read in IAS 28. You all will be able to see. Wait, let me give that also. Let me give that also. In, sometimes here and there I might deviate, right? Here and there I might deviate. So stop me when you all feel that you all feel that it's irrelevant. Right, you all need to study IFRS 3, you all need to study IFRS 10, you all need to study IAS 28, and as well you all need to study IFRS 11. Right, these are the requirement number A, question number 1. Right, if you all do that, you all will be able to get at least 3 points, guys. You all will be able to at least get 3 points. Right, you all will be able to get at least 3 points. And here, see, now I'm coming to prove. If I need to determine control, right, you all need to have these points, right? You all need to show these points. If you need to have control, you all need to show these points. Who is the party who's paying through shares? The party who's paying through cash? Who is the largest entity? Who has the right to appoint board of directors? Whose major management or whose former management controls the entity, right? Based on this given para, I would say this was achieved. The right of appointment, where we saw 60 is to 40, that was there, right? The party who paid cash, this point was not achieved because both are equal. This point was not achieved because both are equal. Obviously, right? Both of them paid for 5 million cash, both of them paid 8 million, right? So this point number 2 was not achieved at all. Point number 2 was not achieved at all, right? You were not achieved at all. So let me put in red. You were not achieved at all. But the point number 1 was achieved. Why? Because Colombia paid in addition shares, right? And also they were 60% to 40%. And number 5, this also was achieved. This also, guys, was achieved. How? Obviously, right? The key decisions were made by only Colombia. Key decisions was made by only Colombia. If you all have this, right? If you all have this, I would say that you all are able to gain in at least minimum 6 to 7 marks. Right? You see, read on this point. Right, by looking at the cash payment, guys, we would say that both of them look equal joint venturers, right, or equal acquirers, we could say. But no, right? Why? Because why? Because Colombia has given additional share exchange. Colombia has given additional share exchange, guys. Colombia has given additional share exchange. Here it is. Right? So we can confirm that Colombia is the parent. Right? Another argument, you see, he's able to appoint 60% of board of directors. Right? So this is also in favor of Colombia. This is also in favor of Colombia. saying that Colombia is the parent. Is also another one, right? And you all can speak about the veto rights, right? You all can speak about the veto rights. This would outsmart. This would show that you all are thorough with the standard. This would outsmart saying that here see, even though there is veto rights, right? The cancelling power. Even though there is veto rights, the cancelling power. Okay. Even though there is veto rights, the cancelling power, guys, this does not affect the company's return on profits, right? Or what you all could say is, even though the cancelling power is there for Brazil, right? This is irrelevant. Why? He does not have the power to cancel. He does not have the power to cancel the board of directors, right? He only power over the auditors. Does this make sense? Does this make sense? Just because you have the power to cancel or appoint auditors, does it mean that you have control? No. So that is what paragraph number 6 or point number 6 says, right? And also you can speak about the senior management. You can speak about the senior management. Who makes the key decisions? Look at this. Here, see, who makes the key decisions? It is also by the person appointed by Columbia. So finally, guys, come up with a conclusion. This is an important point. Come up with a conclusion. You all can say that this is these are the valid points, these are the arguments, but you all need to give in the examiner, you all need to give in the examiners a conclusion, right? A 1 mark or a single para would be more than enough, right? Conclusion saying that Colombia is the parent, right? You all need to give in examiner that Colombia is a parent. This would get you all that 8 mark. This would get you all that 8 mark. Hopefully all are clear. Hopefully all are clear. First of all, I started, right? Or you can start like this. First of all, you can say, look at this examiner. He's 50%, so therefore he can be a joint venture or a joint control. I'm going by a story, right? After I'm telling no, he cannot be a joint venture or a joint uh, venture or an associate. Why? There was no anything known as significant influence or unanimous consent, right? Then who is he? Then who is he? Then he has to be IFRS 10, which is control, right? By doing that, you'll get 3 marks for sure. Okay. Then, okay. Now he is controlled. He is a parent. If he's a parent, how do I determine? By looking at these factors. If I have achieved these factors, I'm a parent. If I'm not achieved, I'm not a parent. Okay. In this, we can see that through yellow, right? He's achieving payment through shares. He has the right to appoint, and his management is making the key decisions, right? And these are the referrals. These are the referrals or the proofs, right? Directly copy pasted from the paragraph that was given, right? And finally, I came up with a conclusion saying that Colombia is the parent. This is more than enough for you all to get in the marks that is needed, right? That is needed. Okay, and I've given you all the important standards that is relevant to question number 1. Right? If you all know this, you all will be able to pass. Right? You all will be able to pass. Okay. So now we move on to section number 8, second requirement. Right? So what does he want us to do? What does the examiner wants us to do is he wants us to give a brief explanation time, right, on how the fair value of the net assets should be determined when calculating goodwill. Okay. So now you all know, right? Now the story comes as now you all are you all are a parent who owns at 50%, right? So obviously when you all become a parent, you all need to calculate goodwill. That's the method, right? So Now, when you are calculating goodwill, there is something called the net assets of subsidiary. If you all remember, if you all try to visualize or picture, right? You all know if you all need to calculate goodwill, you all need to calculate the net assets. Okay. So wait, let me show that also. So simply, this is what is going to happen. Okay, you all are going to calculate goodwill, right? So goodwill is the difference between the amount that is paid and the net assets or the assets that is being brought in by the subsidiary, right? The difference is known as goodwill. So examiner wants you to speak about this blue part, right? He wants you to speak about this blue part. Can you see here? I've showed it in minus. He wants you to speak about this blue part. Okay. Okay. So that is a question, and it has been only tested for 5 marks. So you all don't need to give detailed elaborations, lengthy paragraphs, not at all. 5 relevant points, 5 marks. Okay. And can you all see here, guys? He is bringing something called as fair value. So you all need to pitch it in a way where you all could use IFRS 13. Okay, so speak always about IFRS 13. Okay, because examiner is specifically stressing on that relevant point. Okay. So let us move on here. See, net assets. Okay, net assets of Fairco, the carrying value. Okay, the carrying value on 31st December 2005 was 32 million. That is the carrying value. Okay, and there are some incidents that has been given. Okay, this is incident number 1, this is number 2, and this would be number 3, right? Okay, so I'll only be reading the relevant points that is used or that is needed to tackle this second requirement, and what is irrelevant, I will simply omit it. Okay, so that's how we do. Otherwise, all of us are going to get confused. Okay, so on 1st January 2005, you all need to understand, right? Because when I was doing this today morning, right, during office hours when I was doing this, even I got confused a bit. Okay. Then soon I went and saw, right? If you all are confused with the dates, just simply go and look. The year end is 31st December 2005. So this is a pre-acquisition, right? Or a pre-investment. Before the acquisition, Peru has gone and invested, right? He has acquired, okay, 6 million coupon bonds. Okay, 6 million coupon bonds for $6 million, right? So I guess each 6 million bonds are valued at $1, which is equivalent to $6 million, right? So when you all look at this, guys, when you all are acquiring bonds, okay, we all need to understand examiners trying to pitch in IFRS 9, whether it's a financial asset or whether it's a financial liability. In this particular question, since y'all are acquiring, since y'all are investing, this is known as a financial asset, right? And I believe y'all know your basics. This would fall under debt instrument. Okay. Now, this particular part is not needed at all. This is just an additional information for y'all. It's not needed at all. Okay. Now comes in the main point. Okay. This 6 million or the 6 million coupon bonds was bought in a company that is unquoted or unlisted. You all know when a company is not listed, guys, what happens is the value of it is relatively lesser than the value of a quoted company. Obviously, right? Or simply let's say example, say Apple, which is a renowned, reputed, quoted company, which is situated in US. Okay, and there's a normal private limited company which is not even listed, right? Which only has 5 or 6 employees in India. Can you all compare both of them together, even though they are part of the same industry? Can I compare both of them together? No, right? Because Apple is a listed company, this is a non-listed company. Okay. Okay. The bond is paid annually on 30th June every year, right? So they're paying 30th. I mean, the interest of the bond is being paid on 30th June. Fine. So this should be coming in next year. This should be coming in next year. Okay, no problem at all. Due to the premium redemption, the effective interest rate, okay, was 8%. Okay, makes sense. Okay, so your interest rates are at 8%. Okay, not a problem. Peruco has a business model to collect contractual cash flows from the bonds and therefore measures them at amortized cost. Okay. So I guess if they are planning on collecting contractual cash flows, guys, under debt instrument, this would be going and shown under OCI, right? But you this time you will be using amortization table cost model, right? That is how it is done. Okay. Now comes in, now comes in Colombia. Okay, now comes in Colombia. Okay, let me change on different color. And I'm highlighting Colombia core, so I'm stressing on this point because now we are trying to see the different. Colombia core holds similar unquoted assets. Okay, same unquoted assets. He also has unquoted. This fellow is also having unquoted. No problem. Okay, but has a business model whereby they either collect the contractual cash flows or sell the asset. Can you all see here, guys? Colombia is also having unquoted company shares, right? Peru is also having unquoted company shares, but the business model is different. You all need to understand that. Business model is different. How is it different? Peru in his individual accounts, he is doing under amortization cost model, right? He is doing under amortization cost model. Meanwhile, on the other hand, this fellow is using OCI model, right? Either he sell it or he gets contractual cash flows. He sell it or get contractual cash. Can you see that both of these people are using different models, even though they have two unlisted or unquoted companies? Okay, so that's the turning point. That is the game point. Okay, that's the game point. Okay, bond with similar risk profile for a similar quoted company were trading at $2 per bond, right? Also, a discount of 30% is considered as reasonable to reflect the difference in liquidity of the two type of bonds. Okay. So now this $2 per bond, guys, hopefully you all are able to understand. This is the price of a quoted company, right? This is the price of a quoted company. Yeah, this is the price of a quoted company. Look at this. Both of these people, Peruco is having an unquoted, Colombia is also having an unquoted, right? This $2 is a price of a quoted company. So be mindful, need be tactful. Okay. A discount of 30% is considered reasonable to reflect the difference in liquidity. What does this mean? What does this mean? Okay. So what this means is, guys, in the market, right? In the global market, a quoted company's bond price is $2, right? And obviously, you all are unquoted, right? Since you all are unquoted, you all will obviously need to be less than $2, right? You all need your share price needs to be less than $2. Sorry, wrong side. You all need to be less than $2. How will you be less than $2? You all need to simply from $2 deduct 70%, right? So if you all deduct from $2 70%, that would ideally give you all 2 into 70%. This is the price of the unquoted company, 1.40 unquoted bond. This is the value of the unquoted bond. When the value of the quoted bond is $2 per bond, right? You all need to give a discount of 30%, or you all need to reduce it by 30%. Why? Since he is unquoted. This is all that you all need to understand. This is all that you all need to understand. Right? This is all that you all need to understand for you all to do this particular question. Right? When the quoted company's value is at $2 per bond, why? Because he's quoted, he is recognized, he will be at the market rate. You all are unquoted, you all be something lesser than that. So after deduction from $2, you all will be valued at 1.40 per quoted bond, unquoted bond, sorry. Okay, that is point number one. Okay, that is point number one. Shall we? Let's do this. Let's do this. Since these are three different situations, let us go and directly write it, and after let us move on to the second situation. That would be perfect, so that you all would have a comprehensive understanding. Otherwise, I would just go on reading, right? And it doesn't make sense at all, right? Okay. So now, for most of you all will be thinking, what are the important points that I need to incorporate? What are the important points that I need to integrate into this question? Well, it's quite simple. Examiner spoke about fair value, right? Here, see, he spoke about fair value. So let us speak something about fair value. Let us speak something about fair value. Here, see, you can speak that fair value is not entity specific, it is market specific, right? Obviously, right? Fair value, sorry, obviously, right? Always the fair value is based on the market, not on the entity. It is always set by the market forces, not the entity. Okay. And also you all can give the definition, right? Here, see, this is the definition, right? I'll write it here. You all can give the definition of fair value. Give this the definition of the fair value, right? If you all want, okay, if you all want. But what I would suggest is, what I would refer to you all is, make sure that at least you all incorporate one or two general points that is related to fair value. That would give your point. Okay. Another point here, see, in order to calculate group goodwill, right? All the identifiable assets, right? Obviously, the assets needs to be identifiable. Otherwise, there is no point. There is no point of your bringing them into balance sheet, right? They need to be separately identifiable to its market fair value, right? You all know here. See, this net asset, guys. Give me a minute. You see, the net assets is at fair value. This total consideration is at fair value, right? Hopefully, you all remember this. If you all don't, please go refer to your FR and come back and do this question. Okay. All of these are at fair value. All of these are at fair value. At the date of acquisition, you all need to remeasure them to fair value. So that is point, but that is the point that I have given here. You see, all those assets, all the considerations need to be bought at fair value, right? And fair value is determined by market forces, not entity forces, right? And here, this is a definition of fair value. Okay. Now we move on to bonds. Okay. You see, in individual statements, investment of bonds can be recognized under amortized cost. Yeah, no problem. No problem. You all can, under individual statements, guys, you all can go and record them under amortized cost model, right? No problem. But when it comes to group, right? When it comes to group, you all need to follow the method that is being used by the parent, right? Follow the method used by parent. Why? By doing this, you all can maintain something called as consistency, right? Hopefully, you'll remember this. This is not a needed information. This is also a value addition to you all. Why? Look at this. Peru is using amortized model. He's also unquoted. Colombia is an unquoted company, but he's using a separate model, right? That is individual statements, no problem at all. But when you all are doing consolidation, when you all are grouping it, you all need to maintain consistency. You all need to maintain the same business model for all the parents, for all the subsidiaries, right? That is why I have stressed here. Here, see, but under group, it is supposed to take the fair value under FVOCI, right? Because that's the model that is being used by the parent, I believe. You see, either collect contractual cash flows or sell the asset. So fair value through FVOCI is the model that is being used by the parent, right? Give me a minute. Okay. So sorry. So y'all initially, I mean, it's under amortized cost model. Because why? Because those are individual statements. No problem at all. But when it comes to group, you need to measure under FVOCI. right? Because this is the model that is being used by the parent. Obviously, right? You all need to maintain consistency. You all can't be recording two different people at two different models. Hopefully that is clear with you. Okay. So what would be the value? What would be the value of the dollar? What would be the value of the dollar? Here it is. 6 million bonds you all are buying, right? At 1.40. At 1.40. So that would be 6 million bonds into 1.40 would give me 8.4 million, guys. It would give me 8.4 million, right? It would give me 8.4 million. It would give you 8.4 million. Let me write that also here. That is, you're having 6,000 bonds, right? 6,000 million bonds at, you all are valuing this at how much? 1.40. This is after discount, right? After discount. This will be the value of the bonds. This will be value of the 6 million bonds that you all are purchasing, right? This will be the value of the bonds after you all are purchasing. Okay. 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 So this 8.4 million, guys, would be the fair value, right? This would be the fair value on when? On 31st dot 12 2005. This would be the fair value as at 31st December 2005, right? This is decided by the market after the discount, right? But in your financial statements, I believe that you all will be recording how much? 6 million you all bought it for. Here, see, you all bought it for 6 million. Here, see, this $6 million, right? And you all will be having on accrual basis, right? So 6 million in how much was the effective interest rate? Is 8%. Is 8%, right? So I'll be having 8%. Now remember, guys, remember this is from 1st July 2005, right? And your financial year end is 31st. So don't make this mistake. Don't make this mistake. You all need to take interest only for 6 months. You all need to take interest only for 6 months. Don't go and take interest for the entire year. Don't go and take interest for the entire year. So in the individual statements of Peru, they would have recorded, they would have recorded, they would have recorded as 6,240, right? They would have gone and recorded as 6,240. This is the value that they would have recorded. But unfortunately, at the market, this is being sold at 8,400. Okay, so the market value is 8,400. You all bought it for 6,000. You all gained an 6 months interest income, and now the current value is 6,240. Right. So the difference is known as an upward adjustment. Obviously, right? Whenever you see this is your upward adjustment. Whenever your fair value is greater than your carrying value, obviously you all need to revalue to the fair value, right? Obviously, you all need to revalue to the existing fair value. Okay. So that is why this creates an upward adjustment of 2,160. Let me show that here. See, 8,400 is the fair value. In your individual statements, you all have only showed under carrying value, which is only worth of 6,240. So the difference of 2,160 is an upward adjustment. It is an upward adjustment. It will be recorded here under this part. You see, working number one, upward adjustment. Height of what? Of whom? It will be shown as under bonds. This is just working number one. Okay. This is how you all do, guys. This is really simple. This is really simple. You all need to know Whenever your fair value is greater than your carrying value, that creates an upward adjustment. Simple as that. Okay. Now we move on to our second requirement. Let me take another color. One of the identifiable intangible assets. Okay, so they have bought an intangible assets at acquisition was brand. Obviously, I know brand in individual statements they are not considered, right? They are not considered as intangible asset. Why? Because they don't have separate values. They cannot be sold separately, right? But at the date of acquisition, you will get rights. You will get rights. Learn IAS 28. Learn IAS 28. Yeah. The brands had a carrying amount of 4 million on 31st December, right? No problem. And is part of other non-current assets. Mm-hmm. Okay. This let us look into later. Right? When we are adjusting the draft statements, this will have an impact. Okay. For the people who know, let's discuss later. For the people who don't know also, let us discuss later. No problem. Okay. So brand, you all are buying brands to buying the brands, you all will get rights. Okay. Columbia Co has a similar branded product. Okay. Peru also has a brand. Colombia also has a brand. And therefore is planning to discontinue the trade of Peru Co's branded product with immediate effect. Can you all tell me why? Can you all tell me why? This would be a huge question mark. Can you all tell me why? Simply, see, this will create a bad name, right? This would be create a bad name. Why? Peru is now part of the parent company who's known as Colombia. Both of them are having the same product, right? Both are having the selling the same product with same features, right? At the same market. Won't it create conflict? Right? Won't customers get misunderstood? Right? Won't customers get misunderstood or won't they get confused? Right? So that is why Colombia wants to discontinue Peru's brand so that the customers don't get confused. Right? Obviously, right? Both are, I mean, when both of y'all, even though y'all are part of the same company, y'all are selling under different brand names, the same product under different brand names, this will create a confusion, a conflict, right? That is why, as a parent, Colombia wants to discontinue with immediate effect, right? Okay. The future cash flows from the Peru's product post acquisition are therefore considered to be nil. Okay. The future cash flows. Okay. So after Colombia buys this, right? After Colombia buys this particular brand, he is not going to get any benefits. Look at this, nil. The benefit is nil. The benefit is nil. But if he sells the brand, you see, if the brand of product was sold to a competitor, right, in order to continue the trade, rather than Colombia using that name, he's planning on selling it to another competitor, right? He can get $5 million. If he uses it, if he uses it, right? If he uses it, he's only going to get 0 rupees or $0 if he uses. But if he sells, he is going to get $5 million. Can you all tell me out of this which is the figure that I need to show? Is it 5 million? Is it 0? Or is it 4 million? 4 million is the carrying amount. Okay, here see 4 million is the carrying amount. Right now, I'm asking from another question. What is the fair value? What is the fair value? And I'm giving you all answers. I want you all to choose. Is it $5 million or is it $0 million? Obviously, guys, this has to be 5 million. See, if I don't use, sorry, if I use, if used, 0. If sold, company can get 5 million cash. So what's the best option? What is the best option? What would be the best option? to sell it, right? If you sell, you can get $5 million in hand. 5 million is a thumping amount. If you keep it, you're only going to get 0 rupees, right? So as a company CFO, what I would say is don't keep it. Directly sell it. Why? Company is willing to give $5 million. If I keep it, I'm only just going to generate $0 of future inflows. Not at all worth. It's a waste of investment, right? It's a waste of investment. Okay, you see, read this point, guys. Read this point. You see, IFRS states that if it's a non-financial asset, right? Brands are known as non-financial assets, guys. Brands are known as non-financial assets. Why? Because obviously they cannot be sold, right? They cannot be traded in the financial markets, right? So they are called as non-financial assets. This you already have studied in your foundation of accounting. What is a non-financial asset, right? So how do you determine values of these brands? How do you determine the fair value of these brands? Simply, you all need to take the best and highest use, right? You all need to take the best and the highest use. Okay. Okay. Does it make sense? The best and the highest use. You see, if I keep it and use it, I am only going to get zero revenue. But if I sell it to a competitor, he is willing to give me $5 million. So what's the best use? 5 million selling is the best use, right? That is what I mentioned. You see, the best use is to sell it at $5 million, right? That's the best use. Okay, that's the best use, guys. That is the best use. Okay. So $5 million is the fair value at 31st, right? 31st December, $5 million is the fair value. It is a fair value, right? But in our books, this has been recorded at 4 million. Okay. So the difference would be you need to do an upward adjustment of 1 million. Simple, right? Makes sense, doesn't it? In your books of accounts, you all have gone and recorded it as carrying value as 4 million. But when you all saw the fair value, it is 5 million, right? So why would you undervalue an asset? It is totally against the law. You cannot undervalue, you cannot overvalue. Take it at the exact market value, right? So exact market value is 5 million. You have gone and stated that 4 million, which is totally wrong. So you need to do an upward adjustment of $1 million, right? So this would be working number 2. Upward adjustment, but this time it's not one, guys. This time it is brands, right? It is brands. Hopefully you all are with me. Hopefully you all are with me, right? This is how I write. I mean, how you all are supposed to write, or how you all are supposed to think, not write, think of how do you all tackle these questions. Okay. So we are left off with our very final question. We are left off with a very final paragraph, which would be your deferred income. Okay. Deferred income. Contractual liabilities. You all know deferred income. Another name for this is income received in advance, which is your current liability. Which is your current liability. Okay, so let me read on, will you? Okay. Peruco has several technical support services contracts which are outstanding performance obligations. So I guess you need to pay obligation, right? You are required to pay for several service contracts for technical services, right? And you all have valued this as 2.8 million, right? This is the carrying value you all have given for these liabilities. For these current liabilities that you all need to pay, you all have given as 2.8 million, right? But here see, guys, these contract will cost 1.7 million for Peruco and any other market participants. Why do you think examiner is bringing market always inside? Why do you think examiner is bringing market always inside? Okay, just think it in your heads. Okay, think and keep. I will read this question and I'll again re-ask it. Okay, to complete. So for Peruco, it's only 1.7 million, right? But for the entire market, they need to pay 1.7 million plus a markup of 30%. is considered reasonable for this type of contract. Okay. So what do they say simply, guys? If it's pay repo, right, which is the fair value has been set by the entity, is 1.7 million. But if it's a market specific, or if it's for the entire market, right? If it's for entire market, that would be 1.7 million cost plus 30% of markup, right? Which would be, I guess, which would be, here it is, which could be, guys, give me a minute, let me calculate it. That would be 1.7 million, 1,700 into 130%, 2,210. See here, see, the entire market is paying for that particular service company 2,210, but you're only paying 1,700. You tell me, as a student, as a SBR student, what is the value that you need to take? Is it 1,700 or 2,210? Right? There are some people, since this is a liability, they will purposely try to manipulate it. They'll purposely try to reduce. Right? This is where ethics comes in. Right? Sometimes examiner can test you all with ethics also. Look at this. You all need to pay 1,700. Right? That is what the entity told. That is what your company told. Meanwhile, the entire other organizations are paying 2,210. Right? This is how directors manipulate accounts. They purposely understate the liabilities and overstate the assets. This is how they can understate. And now see here, they will tell no, 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 we don't need to pay 2,210. That is the value that is being paid by the other market people. We will only need to pay 1,700. But as a professional accountant, is this correct? Is this correct? When the entire market is being paid at 2,210, you all are only going to pay 1,700. Is this correct? Right? Some people can argue, sir, what, I mean, this can be a discount. But my question to you all, has the examiner told this is a discount? No, right? The examiner has not mentioned anything about discount. So this is a complete deliberative act of manipulation of accounts. This is a complete deliberation act of manipulation of accounts. Look at this. When the market is paying 2,210 as a liability for the services that they got from the technical industry, you all are only paying 1,700. Right? Why do you think? Why do you think our financial controllers like to manipulate with this? Because obviously their profits are getting, I mean, sorry, their bonuses are getting affected. The more the liability they show, the more the risk. The more the risk, the shareholders will get scared. When the shareholders get scared, they feel that this is risk, right? So they'll pull off their investments. So directors' bonuses are affected. Think in a way, right? Think in a way. It's a story. It's a process. How it affects. This is why the directors are scared. Okay. So what I mean, sorry, I again debated, my bad. Right? You all need to value at 2,210. Why? Simple. Why? This is the price being paid by market force. Right? This is the price that is being paid by the market. Right? You all look at this again. Look at this again. IFRS 13 says, do not look at entity perspective. Always look at the market perspective. Right? Hopefully this makes sense now for you all. Hopefully this makes sense for you all. Always don't look at the entity. Always look at from the perspective of market. Here, see, at the market perspective. Okay. From the market perspective, I need to look at it. So now, what would be the impact on goodwill? What would be the impact on goodwill? Okay. Look at this. The carrying value is 2.8 million. Okay. The carrying value is 2.8 million. But the fair value, right? Let me put this even more in a detailed manner. Carrying value of current liability is 2.8 million. The fair value of the current liability is how much? 2210. Can you see there is a decrease in liability? You all have overstated your accounts. You all have gone and mentioned as 2,800, but it is ideally supposed to be at 2,210. So can you see? You all need to decrease by $590,000. You all need to decrease your liability. Decrease in liability. Can you see here? You all need to decrease. But this is not the question at all. This is not the question at all. My question to you all is, if I decrease liability, what is the impact to net asset? This is my question. I want you all to think about this and tell it in your next recording or next class where we will could meet. Right. So I'm going to end off this class. I'm going to simply stop the class. Right. I'm going to stop the recording. It will be uploaded as soon as I complete the very next session. Right. I will be completing that. We are left off with B and C requirement. Don't worry, I'll complete that. And after that, we could meet in our live session again where you all could clear your doubts. During that time, don't worry, right? I want you all to tell what is the impact when there is a decrease in liability, right? So people who are going to read my tool, people who are following this Excel sheet, don't worry, I'll upload this as well. But I want you all to think a bit, right? Think a bit and come back. Let's see. Okay. Thanks a lot. Good night.